Gautam Duggad, Head of Research Institutional Equities at Motilal Oswal Financial Services. He's joining us right now on the show. And this conversation primarily revolves around how the earnings season, the Q3 of FY20, has shaped up so far. Gautam, good morning. Thanks for joining in. We're at the fag end of the earnings season. So far, how has it shaped up for you?
Hi, good morning. Yes, we are about to end the earnings season today, I think. I have to say that earnings season has turned out far better than what we thought. Even though when you look at the numbers on aggregate basis, they are broadly in line. But there was a fear in my mind that, these numbers will be, missed badly. That has not happened. So we have so far at around 48 Nifty companies done 13% kind of profit growth, which is in line with expectations completely. And at PBT also somewhere around 10% kind of PBT growth, which is in line. Broader Motilal Oswal universe of 220 stocks, we have seen again largely in line kind of a PBT and PAT. So I would say that earnings season is in line, but in this kind of environment where every single day there is a bad news on the macro front, I had budgeted for a big miss. So that has not happened. So no bad news itself is a good news as far as earnings are concerned. Secondly, what remains concerning as of now is still the earnings revision. So for FY21, we have broadly seen 65 companies where the earnings have been downgraded by more than 3%, and only 40 companies where we have seen earnings upgrade of 3% plus. So earnings upgrade to downgrade is still tilting more towards downgrades for FY21. And that is a bit concerning because the expectations of the market for FY21, including us, is quite high. So I would think that there is downside left as far as earnings estimates for FY21 are concerned. Going forward over the next 6 months, you will see some more, reality sinking in those estimates from a bottoms-up perspective. Top down right now, we are building in somewhere around 24-25% earnings growth for FY21. Obviously, I know last 5-6 years, these estimates have not materialized. 21, there are two factors. BFSI continues to do well. There is a normalization of credit cost which is built in. So that is providing a significant bump. But typically we get lost in the quarterly noise. It is also important to look at the annual numbers for FY20. One important thing that I thought I should point out is that in FY20, if you look at the Nifty earnings growth expectations right now, and now that 3 quarters have passed, this should be there at around 9 to 10% full year earnings growth for FY20 Nifty earnings. But if you remove BFSI, then we are seeing a 2 to 3% earnings decline. So it's at a 4-year low in terms of earnings growth for Nifty. So let BFSI not mask the overall earnings story. So important to look at numbers ex BFSI also in this kind of an environment. So that essentially tells you more than 100% of the incremental earnings in FY20 is coming from BFSI. So yeah, I mean, as far as quarter is concerned, I will take it. It's an inline kind of quarter.
Gautam, then to just extrapolate what's happened, now we've just got one quarterly performance, that's Q4 left, to judge the entire year of corporate India in terms of earnings performance. Do you feel Q4 now will be watched with a hawk's eye, or rather the pressure for corporate India to outperform in Q4 is much higher in order to meet those yearly targets that they've set out?
See, targets are set out by analysts, not by corporates. So corporates will deliver what they have to deliver. The analyst will have to, come back to reality. That's what we've been seeing for the last 4 or 5 years. Having said that, the expectations from fourth quarter are high because of some base related fluctuations in some large caps. But as I said, full year earnings growth expectation is around 8-9%. And I think that's achievable because the first 9 months are tracking well on that front. I'm more worried about FY21 because if you look at the expectations are very high. And if you look at the ground reality and commentaries coming from various sectors, it's not yet suggesting that, we are looking for a V-shaped kind of a recovery either in consumption or in investment or in export oriented sectors either. And going by the budget, which was more, tilted towards maintaining the fiscal prudence and looking at long-term sustainable growth, I think there is a fiscal stimulus which is missing. So therefore, from a macro point of view also, FY21 GDP growth, we will be lucky if it crosses 6%. So we have to keep these things in mind when we look at the corporate earnings expectations as well. So therefore, I'm more, worried on FY21 right now as far as earnings are concerned. FY20 seems like that 8-9% kind of an earnings growth, with usual, one or two sectors driving it. As I said, BFSI is the only sector which is adding incrementally to the earnings. FY21, at least in Excel sheets, there is an expectation of broad basing of earnings, wherein around 40% incremental earnings will come from BFSI. Auto is expected to contribute in FY21, so is technology, consumer, and also oil and gas. Oil and gas has been a big drag. Metals has been a big drag for both FY19 and 20. So earnings picture is looking, a bit muddied because of this commodity-oriented sectors, and is looking better because of the BFSI. And that's usually the case every year.
Gautam, good morning. Neeraj here. What have you made of the consumer earnings thus far? They've been chalk and cheese. Some odd numbers like Page haven't looked all that great. And volume growth too, while it may have been great for HUL, which by the way, the note of yours created quite a stir, but some of the others have had some issues, at least in the second tier FMCG names. Absolutely,
Neeraj. As far as consumer sector's quarter is concerned, it's clearly a case of two different world. Lever is in a different world, Titan is in a different world, and rest all consumer companies are living in a different world. So you look at Marico, they reported a volume decline. You look at Godrej, their volumes were very subdued. So is the case for Colgate, Jyoti Labs. Dabur did a reasonably, okay kind of a performance, but volume growth was muted again in Britannia, Pidilite. So, barring Lever, Titan, most of the other consumer companies reported an extremely muted set of performance. Page, obviously, is a big miss that we have seen yesterday. So what is happening, Neeraj, clearly is in this kind of an environment where there is no tailwind for consumption actually, either from government or from anybody else. What is happening is companies which have a very strong competitive advantages, be it distribution, be it a very broad portfolio like Lever has, and extremely strong go-to-market capabilities. They are the ones who are able to, provide some sort of a resilience to their performance, and which is why you are seeing far more polarization even within consumer universe. So, you have on the one hand companies like Lever and Titan, Britannia, Pidilite, where performance over the last 3-4 years has been reasonably decent. And on the other hand, you have tier 2 consumer companies, which despite being 1/3, 1/4, 1/5 of the size of Lever, are growing volumes at half of what Lever is providing. So you are seeing that migration, and we continue to expect that, and that was the reason for that note. We had an aspirational margin target of 25% back in 2017 for Lever. That seems to be already there, and if you look at the portfolio there, we are seeing that they can clearly move towards 27-28% in the next 2 years. They've been one company across corporate India which has benefited the most from the GST given their execution prowess in the market. So coming back to your question, expensive valuations in this sector makes you far more cautious. So therefore you have to back the right horses, where their portfolio is good, where the execution is good, and where the long-term opportunity is also good. So that's why out of the 25 consumer stocks that we cover, our preference is only for 3-4 names. On the discretionary side, we have Titan, where we have very positive short-term as well as long-term view. And on the stable side, we have Lever, we like Pidilite, we like Britannia. That's how we are right now positioned in that space. But I have to say that this whole polarization is not just in consumer sector. Virtually every sector you are seeing that market share, profit, and therefore consequently the market cap pool is getting concentrated in favor of 1 or 2 companies in that respective sector, be it real estate, be it cement, consumer, private banks, NBFC. I mean, this trend is playing out since last 2-3 years, post all the structural reforms that we've seen.
Gautam, what about the premiumization getting hit? I mean, Page is probably a case in point. Eicher Motors, the numbers and the volumes probably also indicative of that. What do you do with some of these plays? I mean, even in the auto space, what do you do with an Eicher vis-a-vis a Hero, or for that matter a Maruti vis-a-vis some of the others?
So Neeraj, clearly auto sector has gone through a lot of pain in the last 2 years, and what is playing out from a very top-down perspective is our economy has seen no income growth in the last 3 years, so very little income growth. And leverage has gone up in the last 3-4 years, which our economists have been highlighting in the last 2 years through his fortnightly Ecoscope notes that while the income growth has stalled, the leverage had gone up because of the expansion in the NBFC market from 2015 to 2018. And then subsequent to 2018, post the IL&FS crisis, NBFCs have been lying low, and therefore the credit market has also got more tighter and banks are also reluctant to lend. And at the same time, the underlying income growth of a consumer has also gone for a toss. So you are seeing a big impact on the discretionary side. Juxtapose that with the cost of ownership going up by 20 to 25% for the auto sector, be it because of ABS norms, safety norms, and now insurance, and then the forthcoming BS6. So your income is not going up, but the cost of owning the vehicle has gone up. So the only way auto sector can react is with the monthly volumes going down and down. So what we are of the view is that short term nobody can predict. 3 months down the line you have BS6. You may have to reassess the whole auto sector thesis in the short term after 6 months, depending on how the transition plays out. From a slightly longer term or medium term perspective, where we like or which are the stocks that we like in the auto space are the two that you already mentioned. One is Maruti and second is Eicher. Having said that, we have no rosy notion about the short term. We know that monthly volumes are going to remain extremely volatile and dependent on how this whole transition plays out, how the discounts shape up. Monsoon also plays a part in the two-wheeler, but not for Eicher particularly. So it's a tough journey ahead for auto. We'll have to wait and see. From a structural point of view, Maruti and Eicher remains our preferred view. The other question you asked was on premiumization. So clearly, again, at the cost of repeating, let me also refer to the point I made, which is that the income growth for the consumer in the economy has come off significantly. And the push from the BFSI side, which is the banking and NBFC, in terms of giving more credit to the consumer, that has also got hit. So both the key drivers of consumption are missing. So therefore people are right now consuming only the most essential things and something which they cannot live with. Wherever they find a deferral of consumption, they are doing it, be it durables, be it discretionary. Page is a clear example of that, and there will be many such categories which are part of the lifestyle consumption oriented. So it's a tough ride ahead, and therefore from an investment point of view we have to do more bottoms up work, and we have to be far more stock specific and cautious in nature in this kind of an environment.
Okay. Gautam, the other sector that's probably coming a lot more in the limelight suddenly, and also in the back of surprisingly positive earnings, has been the entire healthcare space. So hospitals has done well. Diagnostics, probably you're seeing a little bit of a split between what the key players out there have done, Metropolis versus Dr. Lal, but overall it's been a decent performance. And then pure play pharma, there too you've had companies delivering and meeting street expectations. Are things becoming a lot more better out here?
Yeah, incrementally it's looking better than what we've been used to in the last 2-3 years. At least we are not seeing an earnings decline there. But what is also playing out beautifully in the pharma sector is within the pharma there is a clear-cut migration from the old generic large cap companies towards the new age, whether it is a diagnostics or a hospital, or within the old space towards the mid caps. So if you see, if you take a step back and look at the earnings pool of the pharma for my universe in the last 5 years, it's broadly stayed flat for 5 years. FY15, the complete Motilal Oswal pharma universe earnings were around 17,000-18,000 crores. Today in 2020, we are ending at somewhere around 20,000 crores. So 5 years, no earnings growth. Plus plethora of irritants, US FDA, price control, no pricing growth in US, in fact there is a pricing erosion. So multiples also have come off in line with the ROEs. If you look at the ROEs of the pharma large cap companies in the last 4 or 5 years, they're barely double digit now, 10 to 15% in that band. The same ROEs used to be 20-25% 5-6 years back. So there is a well-deserved PD rating which has happened. Now, what do you do in this kind of an environment? So we are, in our model portfolio, we are still having Lupin, which has been there for want of a better choice. Secondly, we've been very positive on Alkem and Ipca. So Alkem is also a part of our model portfolio. They have delivered excellent earnings in this quarter. and so has IPCA 2 days back. In fact, we have seen 10% upgrade in earnings estimate for IPCA, 5 to 6% earnings estimate in case of Alkem. So you have to be very stock specific again, because in each stock they have their own concerns or drivers at play. In pharma, there is nothing called as a sector trend. So, and unfortunately, we don't cover hospitals or diagnostics at this stage. It's been a miss for us, especially the diagnostic story. But that looks good. I mean, if I recall, we had pointed out in our value migration report 3-4 years back that one of the trend that is going to play out in value migration clearly is the diagnostic space becoming far bigger, and therefore companies within that space multiplying their earnings. So from a earnings perspective, this is a very good space to be in. But yeah, I would still not get very positive on pharma, at max neutralish. And we'll have to keep observing how the earnings scenario shape up, because you're still not getting comfort on US pricing, you're still not getting comfort on regulatory headwinds.
Okay, got that. Gautam, it was great chatting with you and getting a synopsis of how Q3 FY20 shaped up and what's the projection or the outlook going forward. So FY21 seems to be a tall order. Let's see whether or not corporate India can meet that. But we're going to take a very short break. The markets are in fine fettle. We've got 12,229 for the Nifty. Nifty banks up 140 points. Joining us next is an industry veteran and former HCL Tech CEO Vineet Nair to talk about the IT industry and the growth outlook going forward.